Hi there, welcome to Kneppy Invest. In today's video, I'm going to be featuring a company that just celebrated 60 years on the ASX, and that company is GUD Holdings. Not sure if they did have a celebration because I'm not sure if this is something companies realize, but GUD Holdings did list on the ASX in June 1962. So the company itself has been around for a long time. And to be honest with you, I knew very little about this company up until recently, simply because I don't think it's that popular. But the company has grown over these 60 years, and it is on the ASX 200, or it's in the ASX 200 index. So it's a big company. Now, GUD Holdings owns a portfolio of companies in the automotive aftermarket and water product services or sectors. And to be honest with you, in the water product sectors, they don't only really have one brand or company, and that is Davey, but they owned a plethora of different companies or brands in the automotive aftermarket. I'll talk about some of those brands later in the video. As I continue in this financial year 22 video series, the next 5 companies I'll be featuring include SEEK, Fiducian Financial Services, which will be the next company I do a video on, BHP and Bapcor. And Bapcor just had the AGM, so not only will I look at the financial year 22 results for Bapcor, we'll also have a look at some of the stuff in the AGM. And the reason I really am interested in AGMs this time of year, so you get a lot of AGMs in October and November, is because management might give out some guidance, potentially the first guidance of the financial year, or they might update, upgrade, or downgrade the guidance they have already released. In fact, we have seen quite a few upgrades and downgrades over the past few trading days. I just had a look at the Bapcor share price. So I'm doing this video, recording this video 45 minutes after trading has begun. I haven't had a look at anything to do with Bapcor's AGM. The Bapcor share price is up a little bit. So more than likely, there was nothing surprising in their AGM, their presentation or anything like that. So Bapcor, I look forward to doing a video on that company. In fact, I look forward to doing video on all these 5 companies. And that's why I have included these companies in this video series. Now, just to expand on what actually GUD does, and I'll just briefly talk about their water product company, which is Davey. It is highly respected, and this is an international company. You can actually go to the Davey website. I'm not sure if you can get to that website through GUD, but I just Googled it. So we're talking about home and garden, farm and irrigation, pool, water treatment, and commercial. And Davey is a small part of GUD Holdings. So I did have a look or broke down the revenue for Davey, $127 million of revenue in financial year 22, $8.9 million of EBITDA, and that's underlying EBITDA, and that is significantly lower than the automotive aftermarket that GUD Holdings have. In that automotive aftermarket, GUD had $576 million of revenue and $144.6 million of EBITDA. So most of the action in this company, the focus of this company is in that automotive aftermarket. And in that automotive aftermarket, these are some of the brands or some of the companies. So we're talking about Ryco, which was the original business of GUD Holdings, and that's in regards to automotive filtration products. They have another company called Wesfill, that's about automotive filters, gasket company here, engine management and electronic replacement part company. There's also the leader in the lighting and electrical accessories segment, that's Nava and Projector. Also looking at accessories for cars and that sort of thing. They've also made a couple of acquisitions in the past year. VisionX, which is the manufacturer and distributor of a range of lighting products for 4-wheel drive off-road, mining, fire and emergency services, and commercial applications. That company or brand has a pretty good margins. I'll talk about that later in the video. They've also made, GUD Holdings also made a significant acquisition during the year, and you'll see a significant rise in revenue. And to pay for this acquisition, they raised the money through debt and an equity raising. That was Auto Pacific Group, which is a clear leader of 4-wheel drive accessories and trailing in Australia and New Zealand. They also have East Coast Bull Bars. Obviously, they're about alloy bull bars and nudge bars in Australia. Also have Unique, which is four-wheel drive off-road accessories. And I could just keep on going, but you get the idea about what this company actually does. Now on to the quality of GUD Holdings. And this is really important for me because when I first start researching a company, I want to understand what that quality of company is, because the way I treat high quality companies is quite a bit different than the way I treat low quality companies. For example, for high quality companies, it's all about value. If I see a really good value proposition for a high quality company and the share price is in a downtrend, I don't care because of that value proposition. But for low quality companies, it's all about the share price. Is it in an uptrend, or is the share price at a really strong, say, support level? So then I might become interested in taking position in that company, regardless of the value of that company at that point in time. So what do I consider GUD Holdings? It has been on the ASX for 60 years, probably been in existence for a lot longer than that. But even though this company has experienced growth over time, hasn't been significant growth. So I'd probably place GUD Holdings somewhere in between a high quality company and a low quality company. And to be honest with you, when I looked at the longer term chart, and I'll show you that in the next slide, there is an opportunity to be buying this company just based off a really strong, well, the share price right now is at a pretty good support level. So that could be the reason why you might be interested in taking a short to medium term position in GUD Holdings. So this is the monthly chart for GUD Holdings going back to 1990. This is as far back as some of the charting programs let us go back for this company, but still 30 years of history here. And to be honest with you, between 1991 and 2001, the share price sort of went sideways. But there was a big increase in share price between 91 and about 1998, and then we saw share price pull back over the next 4 years. But from 2001 to now, so over about a 20-year period, the share price has done quite well. It's actually increased from $1.50 to $7.50. So that's a nice five-bagger over a 20-year period. But you do see a lot of volatility. Share price has been as high as $15 a few years ago, and right now has halved from that high at $7.50. But from 2001 to now, there has been a nice little uptrend, which is displayed by that sloping dashed line. And you could also suggest and argue there is a really good trading range. And I've displayed that trading range with that dash line at the bottom and also that solid line to the top. So where the share price gets to the top of the trading range, that's the time to maybe thinking of selling. And where the share price gets to the bottom of this trading range, that's probably it's a good possibility that the share price might rally from there. Not an absolute, because we only have seen the share price get to the bottom of the trading range twice in the past, and right now the share price is right on that trading range. But there's also a horizontal supporting line right under $7.50. That was the lows we saw a few years ago. And the share price, unfortunately, for GUD Holdings has gone below that support level recently. And the other thing is that trading range line at the bottom, the dashed line, and that support level, that horizontal support level, have converged recently. And you'll see that convergence when we look at the daily chart towards the end of this video. Now onto the financial year 22 results for GUD Holdings. Before we have a look at revenue, profit and operating cash flow, let's talk about the valuation, or the current valuation of this company. So the share price is $7.52, and that was a share price a few trading days ago. Current share price is $7.35, but there's not much difference between those two share prices. So we'll just say the market cap of GUD Holdings right now is $1 billion, or around that mark. Now onto the revenue, profit and operating cash flow. Revenue $835.5 million. That is significantly higher than last year because of these acquisitions, particularly that acquisition of APG. Now then you have a look at profit. That does seem really low. Only $27.3 million of profit, and that is significantly lower than previous years. So a few years ago, this company had profits at around about $100 million. Now, when you look at operating cash flow, $72.9 million, in my opinion, that is more representative of the performance of this company. So I'd be more focusing on the operating cash flow, not the profit. And we'll try to figure out why there is a big discrepancy between profit and operating cash flow later in the video. and the earnings per share for the company based off that profit is 22.7 cents. And just a quick comparison between the earnings per share and the share price might give you the conclusion that this company, with a PE ratio of nearly 40, is way overvalued. But again, that's because the profit does seem quite low for the financial year 22 for this company. Now on to looking at some financial history for the company, focusing here on revenue, shares on issue, and also the gross margins. So the revenue is in the blue here. And if we'll say in 2017 or 18, maybe not 18, that could have been just a one-off. But if I was in 2017, I would be a little bit concerned about this company because from 2012 to 2017, revenue dropped from 611 million to 357 million. And during the period between 2012 and 15, gross margins were fairly low. Then all of a sudden, gross margins increased. And then just after this company saw gross margins increase, we started to see revenue starting to climb. So over the past 6 years, revenue have grown, and that has been helped out by some acquisitions, particularly in financial year 22. So we can see that revenues have grown from $438 million in 2020 to $835 million in financial year 22. However, on the flip side, gross margins have fallen from 49% in 2018 to 41% in this current year. Now, to fund some of these acquisitions, the company has gone into debt. So they've raised a little bit of debt, but they've also raised some capital. So shares on issue have increased from 92 million to 120 million. And you can see from 2012 to 2021, shares on issue actually grew from 70 million to 91. Seems like every single year, shares on issue increased by a little bit. So when I did calculate the growth in revenue, it's growth in revenue per share to take into account the change in shares on issue. So over the last 10 years, in fact, revenues per share have gone backwards by 4.6%. So even though revenues have increased from 610 million to 835 million because of the increase on shares on issue, almost double, not quite, increased by 50 million from 70 million, that means the revenue per share have gone backwards over the 10-year period. But much better story when you look at the last 5 years and 3 years. Revenue per share have grown at 8% over the past 5 years and 12.8% over the last 3 years. And one of the reasons those two numbers are pretty good is because what's happened in the past year, particularly because of acquisitions. So the thing we want to know now is a lot of this growth is because of acquisitions. Is there any organic growth? Now onto the cash flow statement, and this is usually the first financial statement I do look at. So I go to the cash flow statement, work my way backward, look at the balance sheet, and then also look at the profit and loss statement. And I'll really focus on the note 18. So right next to the net cash provided by operating activities, the majority of companies will have a note accompanying that. And that note is a reconciliation of cash flows to profits. And that's where we might get an understanding why there is a big difference between profit and operating cash flow for financial year 22. We'll have a look at that in the next slide. The main things I want to see here is just the operating cash flow, if that has grown or fallen during the past year, and also anything interesting in investing and financing activities. And there are some really interesting things here. In fact, I find the most interesting things in those two sections. So operating cash flow have grown from last year to this year from 74 million to 92 million. But the main thing you'll see in cash flows from investing activities is acquisition of control entity net of cash acquired, 786 million, and proceeds from borrowings, 405 million, and proceeds from the issue of ordinary shares, 480 million. That's in cash flows from financing activities. So what they've done with that acquisition, or the way they've financed that acquisition, is almost half through debt and almost half through a capital raising. Now on to note number 18, the reconciliation of profit to operating cash flow. And in this particular note, we're trying to understand why there was a pretty big difference between profit, 27 million, and operating cash flow, 92 million. And that difference we didn't see in 2021. The difference between profit and operating cash flow in that year was only about $13 million. So profit actually dropped from $61 million to $27 million, yet operating cash flow for GUD Holdings actually increased from $74 million to $92 million. So let's try to understand that. So there are a few things I do look at to get an understanding. The first thing is depreciation and amortization. And for GUD Holdings, they actually more than doubled from last year to this year, increasing from $18 million to $37 million. But just below depreciation and amortization, we have one of the main reasons why there is a difference between profit and operating cash flow. And that's because of impairments of inventory and intangibles. And a lot of times impairments are just one-offs. There was no impairments last year for GUD Holdings. That was zero. For this year, it was about $48 million. So that is one of the main reasons why there is a discrepancy or a difference between profit and operating cash flow. And there actually could have been a bigger reason, because if you take the profit and total up all these depreciations, amortizations, and impairments, you'll get a number of around about 130, 140 million. So that difference between profit and operating cash flow could have been larger. But then you have a look at changes in working capitals. And there are some changes in working capitals that make the operating cash flow a little bit lower than it could have been. So for instance, they've increased their inventories by $36 million. The trade receivables have increased by $9.5 million. There've also been a slight increase in payables by $5.8 million. So that is actually a cash outflow. So that operating cash flow could have been towards $130, $140 million if they didn't increase their inventories, and then if trade receivables and trade payables went the other way. This particular slide is from GUD Holdings presentation, and there are a few interesting nuggets here, just want to briefly touch upon. The first interesting nugget is revenue. So revenue actually did grow 50% from last year to this year, but there was automotive organic growth of 6.5% and water organic growth of 11.9%. But the majority of the growth in revenue was because of those acquisitions, and we already surmised that. But it's good to see this company is still growing organically. That's actually a really good thing. The other interesting nugget here is in regards to impairments. So there was an impairment expense, inventory, Davey, $10.5 million. Also an impairment expense, intangibles, $37.5 million. So it seems like all the impairments was because of Davey. Maybe Davey was underperforming. Maybe Davey inventory was built up a little bit too high, or higher than it should have been. So those are the main things or main interesting nuggets I found here. Acquired amortization, APG and Vision X, $10.1 million. Not sure I really agree with how accountants do amortization, because sometimes a company will buy another company and that company has, say, a lot of subscribers, and the general thought is those subscribers will eventually leave the new company for some reason. That's not totally true. And sometimes those amortizations can be a little bit higher than they should be. And that makes it seem like the company is not doing as well as it is actually doing if you just focus on profit and not look at underlying profit, because underlying profit or EBIT or EBITDA will actually not take those amortizations into account. Now to the two acquisitions the company did make, GUD Holdings did make. The big acquisition was APG Performance, revenue of $132.7 million in about 6 months. So I just mentioned in note 6 or note 3 here, that 6-month contribution. So this company is pretty big, and that's why they spent a lot of money for this acquisition. Underlying EBITDA $24.3 million. They don't have any profit here, but I did notice that, even though I have not shown it here, that apparently APG underperformed. So it was a disappointing performance from APG in the first 6 months that this company was in the GUD Holdings portfolio. Now, Vision X was really interesting because revenue of only $35.1 million, but underlying EBIT of $10 million. So underlying EBIT margin of 28.3%. So it does seem like Vision X is a higher margin business. When you look at the underlying EBIT margins for APG, that's only 19.4%. So it seems like Vision X was a pretty good acquisition at this point in time, and that revenue and underlying EBIT was only for 7 months, because they bought this company about 7 months ago, 30th of November 2021. Now onto the valuation metrics for GUD Holdings. I've already mentioned, probably shouldn't focus on PE ratio, because 38.5 for this company does seem high. So if you just focus on that and nothing else, you'd probably say this company is amazingly overvalued right now. Price to sales ratio 1.26. To be honest with you, I don't really focus on price to sales ratio for most companies, but it does give an idea if I know what the price to sales ratio usually is for a company over a 10-year period. For GUD Holdings, 1.26 sounds about right. But price to operating cash flow, 14.4. That gives me a little bit of better idea whether this company might be a little bit overvalued or undervalued, but I wouldn't say that is too high or too low, particularly when I did a reverse DCF, focusing on the operating cash flow, not the earnings per share, because if you did the reverse DCF based off the earnings per share, you'd get a really high number here. But when I base it off the operating cash flow, I get 8.8%. So if you don't know what a reverse DCF is, it's just the growth in the company over the next 10 years to justify the current valuation. I think this company can grow the operating cash flow at 8.8% over the next 10 years. So I wouldn't say right now that this company is overvalued. Now to the trading update the company did give, and this is only the first month or so of the trading year or the financial year. And I think once the company goes through their AGM, that's when you get a better idea, and management will have a better idea of how the company is performing. And that's why sometimes you'll see a share price of a company increase or decrease a lot just on their AGM, because usually companies will provide a trading update and some guidance, profit upgrade or downgrade during the AGM season. Anyway, on to this particular trading update, and the focus on three areas: automotive, APG, and water. And one of the reasons they're focusing on APG was because that is a significant, or was a significant acquisition for this company, and shareholders and stakeholders of this company are probably interested to see how that acquisition is going. So a few nice, interesting nuggets here, pieces of information. So in the automotive, they're stated here that sales have started positively across many of our legacy organic automotive aftermarket businesses. Pricing increases through Q1 and Q2 are being implemented to offset further cost increases. And in the APJ, they mentioned there is a little bit of headwinds right now. So broader Q1 OEM orders still muted due to their component supply constraints. They do expect some positive momentum because of a new Ford Ranger rollout, but price rises implemented July 1 to offset Q4 cost increases. So maybe a little bit of pricing power here for GUD Holdings. And in the water division, demand remains strong into financial year 23, and sales have started positively, and cost inflation is prompting further price rises in Q2. So some nice little pieces of information here. Talking about some headwinds and tailwinds. And the main thing I get out of this is they are a little bit positive with the outlook. And the other thing is that this company does have a little bit of pricing power. So they're increasing the prices of some of the things. And that actually is positive, particularly if inflation remains elevated for a while yet. Now onto the daily chart for GUD Holdings. And this goes back just over a year. Share price has been as high as $13.20. That was back in February of this year. So the share price has fallen, almost halved since February, and the share price is in a downtrend. It has been a downtrend for quite a while. So we're talking about a 6-month period. Share price is right now, and when I'm doing this video, a fairly long period low. Share price has moved through that resistance or that support level at around about $7.40. And you can notice I've also included that trading channel. So remember, GUD over the past 20 years have been trading in a channel, and that support level at $7.40 and that trading range have converged, and the share price is right on that convergence right now. So possibly we might see a bounce in GUD Holdings, but if the share price falls lower than about $7.40 for a longer period of time, and this downtrend in the share price continues, that would be a bearish sign moving forward for this company. So even though I don't think this company is overvalued or even undervalued at these particular prices, just based off technicals, right now share price is at a good solid support level. So we don't want to see the share price of this company fall significantly further from here. Unless, of course, you are very bullish about the long-term future of this company And if you are, you want the share price of GUD Holdings to be as low as possible so you can buy as many shares as you can. So that's really all I have for this video, looking at GUD Holdings and 60 or celebrating 60 years on the ASX. A nice company that I wouldn't call high quality or low quality. Company has slowly grown over the past few years, but I think all eyes are on that acquisition of ASG. Is it going to be successful? Research has shown that the majority of acquisitions aren't successful for the long term, particularly in growing capital returns or shareholder returns in that company. Will that be true for GUD Holdings? That remains to be seen. So that's really all I have for this video. If you have any thoughts, any comments, any questions, just leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.